Hi everyone, this is the Med City CPA, and today I'm going to talk about Mama Bell, or AT&T, ticker symbol T. Before we get started, yes, I am a real-life certified public accountant, or CPA, but I am not your CPA. This video is only intended for educational, entertainment, or information purposes only. Please do your own research before making any of your own investments or decisions. Okay, let's get started. Over the past decade, what we've been experiencing in the stock market has been some pretty exceptional returns following the 2008 financial crisis. What we started experiencing in 2009 was more than a decade of prosperity throughout most of the stock market, but that all changed when we entered into 2022. This year so far been the worst year in the stock market since the Great Recession, with the S&P 500 currently being down over 18% year to date. The good times we experienced over the last decade appear to be over, at least until we bottom out of this current bear market we're in. Fortunately for me, because I pursue dividends over share price performance, I haven't really paid attention or felt the burn like growth investors. In reality, many of the high-yielding dividend stocks in my portfolio continue to increase or maintain their dividend payments this year, and are estimated to keep doing so regardless of how the rest of the year treats us in the marketplace. To my knowledge, none of my individual stocks have reduced their dividends this year, which is great. So in today's video, I'm going to go over some of my stocks in my dividend portfolio that continue to grow or maintain despite the current downturn. So AT&T, or Mama Bell, is probably the most controversial stock this year because last year, in 2021, it made headlines about its dividend with a spin-out of a major subsidiary and other restructuring. So AT&T, or ticker symbol T, the AT&T stock was largely known as a consistent dividend growth stock until the slash of 2021 from $2.08 per share to an estimated $1.11 per share in 2022. That's about a 50% cut in the expected annual dividend. This was quite noticeable for investors like myself who are more passive in their investment strategies. So why would anyone be interested in AT&T after the cut in the passive income? Well, simple. Look at the Q4 2021 financial details. Looking through the financial information on the AT&T website, you can see why AT&T remained an attractive purchase. As of the end of 2021, the unaudited financial statements at the time indicated that AT&T had revenues that were up year over year of 4.2% or $1.6 billion, excluding video that would ultimately be spun out into the Warner Brothers Discovery deal. That leads to an adjusted earnings per share of 78 cents. Looking at the cash flow, which is one of the other indicators that I like to look at for a strong candidate for passive income investment. Cash flows were up year over year for a 2021 cash flow of $26.8 billion and a dividend payout ratio of 56%. Just to be clear, the dividend payout ratio is generally the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. Some would say this dividend is too high because of a potential dividend death spiral, where a company would be forced to keep raising the dividend to attract investors while siphoning off cash flow for the operations of the business. I didn't think AT&T was at risk for a dividend payout death spiral because AT&T announced the nearly 50% cut to the dividend earlier in 2021. AT&T is willing to grow the business and stabilize future dividends by cutting today's dividend. That made sense back in Q4 of 2021. So how did investing in AT&T in 2021 turn out for me specifically? Well, actually pretty bad. The U.S. economy turned bearish. The overall stock market, as I said, plunged over 18%, and inflation is now over 8%. But let's look at my actual numbers. As always, my timing with investments is not always the best as a excited investor. I'm always looking for a value, and when AT&T slashed their dividends, announced the Warner Brothers Discovery spinoff, and other restructuring, I was excited for buying AT&T on a discount. Here I've listed all my investment transactions for AT&T. Some purchases are approaching 50% losses, but that's not all bad in the long term. In the short term, yeah, it looks pretty bad. This is the importance of dollar cost averaging over a long period of time. In other words, buying small amounts of stock every month over the course of a year instead of a few big purchases. Live and learn, I guess. Don't make my mistake. Over the year, I am showing unrealized loss of over the short term, I am showing an unrealized loss of 31% and a dividend yield on the initial investment of 4%. That's still higher than a savings account right now, but really not by much. This is really bad news. Over the long term, I am showing an undervalued company. Well, let me explain. A lot of value investors advertise that buying stock is essentially buying a small piece of a larger company. Looking at my shares, I'm a very small owner of a very large conglomerate. The financial statements show an increase in the return on investment year over year, but the stock price has gone down. The financial statements show an increase of revenue from the core wireless and broadband customers, but the stock price has gone down. The financial statements are showing a company that is restructuring long-term stability, but the stock price is going down. So there is a mismatch between what we're seeing in the trend of the financial statements and the stock price. There can be a whole another video for the value add-in for the spin-off of the Warner Brothers Discovery segment. So I'm going to leave that piece alone. If, by any chance, Warner Brothers Discovery can return value, then that would be icing on the AT&T cake. I just want to show probably the most important slide of the Warner Brothers Discovery financial statement presentation. Warner Brothers Discovery is making what I think are the correct and painful decisions. For example, they are shutting down CNN Plus. They are restructuring how HBO and HBO is formatted, their segment, and focusing on their core audience of consumers. Their stock price, like AT&T, has gone down. As a value investor, I think that this is a mismatch in the market. At the end of the day, I don't think AT&T is a get-rich-quick company. I don't think in the short term that AT&T or Warner Brothers Discovery is going to produce outstanding returns. But I think management has some true value to unlock in an otherwise long-term dividend payer. I don't anticipate any quick movements in AT&T. I think AT&T is more of a slow-cooking value return company. Nothing exciting, nothing flashy, just a long-term value. So as I always like to say, before investing in any of these stocks for yourself, be sure to perform your own research and due diligence and come to your own conclusion before investing your own money. Always make sure that you have a good understanding of how the companies you're investing in do make their income. That's going to conclude for today's video. Thank you all for watching. I really appreciate it if you found this video informative. Please consider giving it a thumbs up or subscribing to the channel if you want to see more of these type of videos. I'll continue to try to do analysis on my investments. And thanks again, guys, so much for watching, and take care.